Ever wondered what short selling in the stock market is? It may sound complex, but it's actually a fascinating strategy employed by savvy investors. Let's demystify this concept together. Imagine you're an investor. You're keeping a close eye on the market, and you notice that a particular stock seems overvalued. You predict that this stock's price will drop in the near future. Now, you think to yourself, how can I profit from this situation? This is where short selling comes into play. In essence, short selling is a process where you, as an investor, sell a share that you don't actually own. Yes, you heard that right. You're selling something that's not even in your possession. You might be wondering, how is that even possible? Well, stick around and we will unravel this intriguing process together. The premise of short selling is quite straightforward. You borrow a share from a broker or another investor and you sell it in the market at the current price. Your hope is that the price of this share will fall in the future. If your prediction turns out to be accurate, you can buy back the share at a lower price, return it to the lender, and pocket the difference. The profit comes from the discrepancy between the selling price and the lower repurchasing price. However, it's not all sunshine and rainbows. Short selling involves significant risks and is not for the faint-hearted. It requires a deep understanding of market trends and a high tolerance for potential losses. But if you're willing to navigate these choppy waters, the rewards can be substantial. So, there you have it. That's short selling in a nutshell. It's a strategy that allows investors to profit from declining stock prices, turning the traditional buy low, sell high approach on its head. In the next scene, we will delve into the step-by-step process of short selling. Stay tuned to learn more about this intriguing aspect of the stock market. The process of short selling may seem complex, but it can be broken down into simple steps. Let's start with the first step, borrowing the share. In short selling, you don't own the share you want to sell. Instead, you borrow it from a broker or another investor. It's not physically in your possession, but it's made available to you for this transaction. Let's say you're interested in a certain company's stock, but you believe its price will drop soon. You approach a broker, borrow a specific number of shares, and promise to return them at a later date. This is the first step of short selling, borrowing the share. The second step is selling the borrowed share. You sell the shares you just borrowed at the current market price. For instance, if the current price of the share is $100, you sell it at that price. You're essentially selling something you don't own with the promise of buying it back later. Now the third step is a waiting game. You wait for the price of the share to drop. This is where your market analysis and predictions come into play. You believed the price would drop, and now you're waiting for that to happen. Let's assume that after a while, the price of the share drops to $80. Once the price drops, we move on to the fourth step, buying back the share. You buy back the same number of shares you sold at the lowered price. In our example, you buy back the shares at $80 each. Finally, we come to the fifth step, returning the borrowed shares. You return the shares you initially borrowed from the broker. The difference between the selling price and the buying price is your profit from this transaction. To sum it up, in short selling, you borrow shares, sell them, wait for the price to drop, buy them back at the lower price, and then return the borrowed shares. The profit is the difference between the selling price and the buying price. But remember, while this process may sound straightforward, it requires a deep understanding of the market and the ability to make precise predictions. It's not as simple as buying low and selling high. You're selling high first, then buying low. And if your predictions are off, you could end up buying high and selling low, which would result in a loss. Now that we understand the process, let's explore a practical example in our next scene. Let's take a hypothetical scenario to better understand short selling. Say there's a company, let's call it Blue Chip Tech, and its shares are currently priced at $100. An investor, let's call him Raj, believes that the price of blue chip tech shares is going to drop to $70 in the near future. First, Raj borrows 100 shares of blue chip tech from his broker. He immediately sells these borrowed shares in the market at the current price, which is $100 per share. So, he receives $10,000 from this sale. Next, Raj waits. As he predicted, the share price of blue chip tech falls to $70. Now, he decides to buy back the 100 shares he owes to his broker. He spends $7,000 to buy these shares at the lower price. Finally, Raj returns the 100 shares to his broker, effectively closing his short position. Now, let's do the math. Raj initially received $10,000 from selling the borrowed shares. He then spent $7,000 to buy them back. So, his profit from this short selling operation is $3,000. This example should give you a clearer picture of how short selling works. But remember, it's not without risks. The potential for loss is unlimited, as the share price could rise instead of fall. Also, the availability of shares to short is not guaranteed, and an unexpected margin call from the broker could compel the short seller to maintain adequate funds in the account. Despite these risks, experienced investors who understand market trends can use short selling as a strategic tool to profit from downward price movements. While short selling can be profitable, it is important to understand the risks involved. First, let's talk about the potential for unlimited loss. Unlike traditional investing, where the most you can lose is the amount you've invested, in short selling, there's no cap on how much you could lose. If the stock price rises instead of falling, you would have to buy back the shares at a higher price, leading to potentially significant losses. For example, if you short a stock at $10 expecting it to fall, but instead it soars to $50, you would have to buy it back at 5 times the price you sold it at. This is why the potential for loss in short selling is theoretically unlimited. Next on the list is the risk of margin calls. When you short sell, you're essentially borrowing shares from your broker and selling them in the market. If the stock's price starts to rise, your broker could issue a margin call, requiring you to deposit more money into your account to cover the potential loss. If you can't meet the margin call, your broker has the right to close out the position, forcing you to take a loss. Finally, there's the risk associated with share availability. When you decide to short sell, you're assuming that you'll be able to borrow the shares from your broker. However, there may be times when the shares are not available to borrow. This could be due to various reasons like a high demand for the stock or restrictions placed by the broker. If you can't borrow the shares, you won't be able to open a short position. So as you can see, while short selling has the potential to generate profits, it can also lead to substantial losses. It's a complex strategy that requires a deep understanding of market dynamics and a high tolerance for risk. Short selling is not for everyone. Let's discuss who can benefit from this strategy in our final scene. So, who should use the short selling strategy? This question might be circling your mind now. Well, short selling is primarily a tool for experienced investors who have a deep understanding of market trends and have the ability to predict potential downturns. It's not a strategy for the faint-hearted or those who are new to investing. Short selling requires a high level of financial knowledge and market expertise. It's a strategy that involves taking calculated risks based on thorough analysis and research. It's like playing chess with the stock market, where you need to plan your moves meticulously. However, it's important to remember that even the most experienced investors can get it wrong. Therefore, extreme caution is necessary when deciding to short sell. It's crucial to understand that short selling involves significant risks and should be used wisely. Always do your research and consult with a financial advisor before diving into short selling.